all of these are getting you a yield on your money. If you put $1 million in, you're getting that 5.5%. And then they're supplementing that 5.5% or using that 5.5% in some form or another, right? By selling some implied volatility, some part of the distribution. We talked about the distribution that seems compelling. And that might be broadly overvalued relative to the probabilities of its outcome. And allowing you to get an expression of another part of the distribution, or selling both parts that you believe are important. The important takeaway is that it's selling implied volatility. It might be selling, again, a upside. More times than not, these structured products are selling some type of upside exposure. So a call maybe 2 years out, right? Maybe it's a 2-year structured note that is selling, again, 25% out of the money upside, saying, hey, I don't think we're going above 25%. If we do, I'm willing to take my 10% per year and diminish that exposure by 1% as we go up. But as tends to be the case with these structured products, it's worth having exposure on both sides, right? If you want to hedge, maybe it's long a put versus short that call. Maybe it's premium neutral, but more times than not, a lot of these structured products actually have tend to be, something that allows people to get put into the market as well as the market declines to a certain level. Basically saying, look, I don't want to be long the market here, but down 25%, I'd sure like to buy the market anyway. I would do that anyway. I don't want to be long the market here. I'll get paid 10% a year, right? Or 8% or 9% a year to wait. And if it goes down there, I'm happy to be long it. If it continues to go down, I'll take a 1% per decline move in the market from there. But these are essentially options positions. They can have a nice wrapper. They can sound like, wow, that sounds like an amazing deal. Often they involve different parts of the market. It can say, it could be involved NASDAQ calls, Russell puts, different, the S&P 500, maybe, European markets, Japanese markets, et cetera. But broadly, and so they can get incredibly, detailed and complicated. And that's kind of why I don't think it's worth diving into every single variation. But the broader sense here is that you're selling parts of the distribution that are overvalued to help juice your yield and maybe getting some exposure that you actually want along the way, but doing it in a way where you get a nice little yield along the way, and they're a nice non-correlated, exposure to markets that is an alternative to beta.
Love that. Well said. You have it's like the yield stacking, like we mentioned earlier. We have the inflation hedge. So you have the T-bills, the risk-free rate, that's about 5.5%. And then you stack on top of that, you have derivatives, swaps, all the kind of things that there's so many of them. And then you can get that yield to go to double digits, 9, 10%. It's a beautiful thing. These structured products are amazing.